Everybody, welcome back to the Commercial Credit and Collections Conference. My name is Colin White, and I've been presenting sessions this morning looking at credit management challenges across this year. And we've covered a couple of interesting subjects already this morning. We've looked at world trade credit risks. Our last session was very informative as well, really interesting to hear about the fraud threat, but also a bit worrying as well. That was really good. And now we're moving on to our third session of the day, which is going to look at credit or late payment and insolvency. Before I introduce and hand over to my chair for the next session, I just wanted to see if we can get people involved with this session. We had quite a lot of questions on the last one, so hopefully we can go down the same route with this one as well. On the screen in front of you, you can obviously see us, but also you've got an icon. If you have a look at that, that gives you information about this session. On there as well, there's a link to our next session where we're going to look at technology in our final session of the day coming up at 1 p.m. So if you want to sign up for that, if you haven't already, do that. We've also got the little icon which gives you information on our speakers. It's got some profiles, a couple of things you can download if you're interested, or links, I should say, to other things. But the most important thing is we've got a speech bubble there. If you want to ask any questions, fire them away on the platform, and we'll share them with our chair and our panelists, and hopefully we can get some answers from them. Anything we don't cover off, we're writing up a review of this event, so that will be shared on the Credit Connect website next week with anything we don't manage to cover. But let's crack on. I will now hand over to Brendan Clarkson of Begbie's Trainer, who's going to introduce our panelists for this session, and then we'll get into the nitty-gritty discussion around this subject. So, Brendan, over to you.
Thanks, Colin. Morning, everyone. As Colin said, my name is Brendan Clarkson. I'm a director, and I oversee Begbie's Trainer's National Credit Services team. My role is to work with credit managers and credit teams across the country, looking at solutions, remedy, and basically just to be able to understand the insolvency process, what's happening within the process, likely dividends, etc. I'm not going to spend a lot of time. We've got a lot to cover over the session, so I'm going to hand straight over to our first panelist, which is Charles Mayhew. Charles, want to give us a couple of minutes?
Yeah, hi, almost good afternoon, and a couple of minutes off. So good morning for now. My name is Charles Mayhew, CEO of Global Credit Recoveries. Been involved in the international debt collection industry for the last 28 years. Used to be a director at Morton Smith, a business that we sold to Marston's, the big bailiff firm, in 2015. And then 3 years later, I started up Global Credit Recoveries. We cover, with our agency network and our own Dubai operation, debt recovery right throughout the world, and I've built up a very large network during that time, and dealing with lots of CICM members and blue chip clients here in the UK, and about 40% of our turnover is Middle East debt collection as well. So we're seeing a lot of late payment, etc., and recovering costs wherever we can. And also had a fair amount, not a great deal, but probably I would say on average about 15% of the cases that we deal with go on to litigation. So had a reasonable amount of experience on overseas litigation as well over the years. Known Brendan for a long time, since he was 12. Used to pick him up from school. Just kidding. Just keeping it light. But yes, it's good to be on and delighted to be asked and get involved with this. So thank you.
Thanks, Charles. Okay, let's head over to Jason Ainge. Jason is a colleague of mine at Begbie's Trainer. Jason?
Hi, morning, just about, everybody. So I'm a partner based up in Leeds. I tend to deal with things as and when the debt collection process hasn't quite had the desired outcome, i.e. you've got a non-payer, and the consequences of that being when entities need to enter into some form of insolvency process. Generally, my work will be sort of creditor-led off the back of disputes. I do a fair amount of investigation into sort of alleged frauds, including tax frauds and such, with a view to really sort of using the insolvency process as the tool to try and get the recovery, really, on behalf of the creditors.
Thanks, Jason. And finally, Peter Worrell from Moore Barlow.
Hi, good morning, everyone. Apologies if you can't see me. I'm having difficulties with my camera this morning. But as Brendan said, my name is Peter Worrell, and I'm an associate solicitor at Moore Barlow. I currently specialise in insolvency and restructuring, which I've been doing since January 2021, where I primarily act on behalf of insolvency practitioners, assisting with investigations and pursuing claims. Before moving into insolvency, I was the manager of the Moore Barlow debt recovery team, specialising in complex high-value debt recovery claims in a variety of sectors, including professional services, financial services, recruitment, and telecommunications. I've been at Moore Barlow for about 15 years, and at Moore Barlow we focus on helping entrepreneurs, leaders of businesses and organisations, as well as private individuals and families through the opportunities and the challenges that might come their way.
Thanks, Peter. Okay, guys, I'm going to go. We've got about half a dozen questions, and I'll take questions from the floor thereafter. So the first question I've got listed is, do you think there's been a change in terms of late payment, trends during the pandemic versus late payments from the year prior? So I'm going to start with you, Jason. So any thoughts?
I think that generally what you're probably seeing within, like, across businesses is things are starting to get a little bit tighter. There's quite a few things that are happening in the background that are just going to make things that little bit tougher, that a little bit more difficult, and there's an awful lot of other pressures. So we've got cost of living, so we've got internal sort of pressures from employees potentially wanting further funds out. Things are now ticking over in terms of creditors being able to issue winding up petitions, with those having been sort of stayed for a while with the coronavirus acts, and with sort of bounce back loans, etc., and the C-bills now coming up for payment. Things are going to start to get a little bit tight, I would have thought, across various sectors. I think it's still very much a mixed bag depending on which sector you're operating in as to how you're finding the market, but it's certainly not going to get any easier, I wouldn't have thought, in the short term, and people are just going to have to really put some effort into engaging with the customers and encouraging those payments to come through.
Thanks, Jason. Peter, any thought on the question?
Yeah, just adding to what Jason said there, really, insofar that there were previously a number of measures brought in by the government to protect businesses as a result of the pandemic, and what that arguably created was a debtor-friendly environment, meaning that businesses had to engage and show an awful lot of forbearance. Now, those measures are starting to be lifted, and as a result, companies are able to be a bit stricter with their payment terms, whereas before it was forced upon them to engage in order to try and collect their money. So, I think going forward, we're still going to see creditors showing that forbearance and engaging at an early stage, but because of those measures have now been lifted, I think we'll also see creditors being a bit stricter with their payment terms as well.
Thanks, Peter. I guess, we've had a few hurdles over the last 2-3 years. We've had Brexit, we've obviously had a pandemic, and now we've obviously got Ukraine. I mean, cost of living crisis is here now. It's on the news every night at 6 o'clock. So how's that going to affect businesses moving forward, guys?
I think from going on to the last question also, and to that one, and then I think clients seem to be delving a hell of a lot more into credit reports, and also they seem to be going back to the old school of getting references and referrals from other clients to benchmark, because it's been such an unprecedented time for everybody and will continue to do so, that I think there's a lot of old school calling up other credit managers and talking to each other about trading, and a bit more concentration on sort of international forums, and really doing some benchmarking as well. So that's just what I'm seeing across the board from a variety of clients. A little bit more old school, and a little bit more reliance on the credit reports to make sure that they are giving the information that's needed for clients to make absolute correct decisions. Certainly on overseas markets as well.
Jason, any thought?
I think it's probably changed quite a number of relationships throughout the pretty turbulent period of the pandemic. I think, you've probably seen a change in the way that some people operate. They've probably identified those customers and clients that are supportive and those that haven't been quite as supportive. So people are potentially, I think it probably is going back a little bit old school in terms of working a lot more with the people that they trust and have built up a relationship with, rather than allowing other businesses and companies that they haven't got that working relationship with to sort of lift their leg and take on additional credit terms and put them in an awkward spot.
Yeah, I think it's a bit of a strange one, I think, on this, because if you think what's happened over the last few years, and me and you, Jason, have definitely seen it, where businesses have had that kind of support, and that's kind of ended, and it ended gradually. You've now got the creditors allowed to do what they want from March the 31st. Have they done it as much as we thought they would? My personal opinion is probably no. I'm not sure what you say, Peter. You're more cold-faced with credit managers on a daily basis at looking at doing things such as winding up petitions. But I do particularly think there is, huge problems in certain sectors. I mean, guys, coming on to that, is there any sectors that really stand out as problematic?
For me, Brent, just on overseas markets and certainly a bit in the UK, it's obviously been construction. That's been standing out as a difficult one for everybody for obvious reasons, and the cost of goods as well, which is still increasing. So that's my quick take on it. And again, Middle East markets as well. All the construction companies and everybody that supplies them as well has been one to watch.
What about you, Peter? What are you seeing sector-wise? Are you seeing anything? I mean, the standard ones, as we all know, would be hospitality. Construction always kind of stands out. Is there anything else that is falling in your lap, or your thoughts?
No, just really agreeing with what you say about the hospitality, construction, and then retail as well. I think they're the main sectors that I've seen be hit as a result of the pandemic, to be honest.
Jason, any thought?
We've seen quite a number of sort of restaurants and pub chains that have had difficulty. I mean, if you were teetering before you went into the pandemic, being put into a situation where you weren't allowed to trade, it's certainly not going to make your finances any better. And we've seen the issue with that. I mean, the others that have kind of struggled a little bit tended to be the self-employed, who've not really had the same degree of support as the corporates have had with the various schemes that have been available, and that doesn't seem to have a specific kind of area necessarily. But given that the economy really is underpinned by service sector, it's no surprise that there's a large amount of people that have been struggling a little bit.
Well, I'm guessing the next one, Brent, we got is commercial landlords, as everybody does or doesn't take up the office space that they need and gives offices back. And that's going to be surely that's going to be a hotbed of insolvency claims.
So I guess, this session is all about late payments. Let's talk about late payments then. So we've seen an increase in late payments anyway. Will a credit team have to change the way that they focus on that, and terms need to be increased, or is it just going to be the terms are going to remain the same and credit teams are going to have to be more aggressive? Pete, what do you think?
Yeah, so I think on the one hand, what we're seeing are firms accepting longer payment terms because they feel they have to in order to get the work in. And what that does is ultimately lead to payment terms in 60, 90, 120 days. However, I think everyone knows how important cash flow is to the survival of a business. And given the current economic situation, firms need to be putting on their own oxygen mask first before putting on the oxygen mask of anyone else, essentially. And what that means is that ultimately firms should be sticking to their current payment terms. But as I touched upon previously, having early discussions and coming up with solutions to the issues that may be being faced. And showing a little bit of forbearance if necessary, but also relying on default provisions if payment isn't made within a set period of time either.
I think Yeah, I think we're seeing people become more aggressive. I know that's something that we started doing, and I presented on something about 9-10 months ago, was how can collectors really cut through the COVID card and really get to the point as to who really can pay and can't pay. And as we all know, a credit report is great, but our collectors started asking for management reports. If people want to trade, asking for management accounts to see really what the trading style is. More people are asking for personal guarantees now. So we've seen an uptake, and directors are more willing to give personal guarantees against their trading. So we've seen that to encourage people to do business.
Charles, jumping on that. I mean, I've seen that as well. And me and Jason have definitely seen that, because the problem I always think with this is that everyone seems to be asking for personal guarantees. But if Mr. Director's given out 6 personal guarantees in the last 6 months, you're number 7 on the list. So it's just one to bear in mind. I've heard a lot of credit teams, and listen, 5 years ago, I was telling everyone to change their team this season, get a PG. I think a lot of them listened, and there's so many personal guarantees out there. It's coming a little bit of an issue now, a bit of a worry, when you're doing it.
Yeah, it does, but at least it sorts the wheat from the chaff, and people who really do want to do business, it's a sign, it's an early indication as to whether or not they can or can't or don't want to do business with you, or if they feel they have to. So, what more can we do? That's another good question that perhaps we should ask. What can the credit manager protect?
I guess for me,
I'm just going to jump in there, Brendan. I don't think it's necessarily a straightforward answer, and it's a little bit fluid, really, in terms of how you deal with this. Obviously, there's the clear alarm bells that'll start ringing if you're pursuing a debt and then everything goes deathly silent on you. Part of the key is probably going to be your sort of regular contact, keep discussions and correspondence going, and but being mindful of those situations where you do need to turn the heat up and issue proceedings, but in a situation where that's going to cost you money in order to sort of commence winding up proceedings, issue a winding up petition, needing to weigh up whether it's worth going down that angle, or if you're chucking good money after bad. I mean, the sort of reports and what have you that are available might give you a bit of an indication. You can see whether a company's racking up CCJs or anything of that nature, which can give you a bit of an indication. And if there's already people that further down the queue, it may be worth your while just seeing whether you can develop the conversations rather than spending your money yourself.
Yeah, do you know it comes on nicely to the next question. But before we go, I'll ask the question is, I think the problem we've got here for all of us, be it credit managers, insolvency, debt recovery, collection support units, is, I guess, a business is only, say, 30,000 quid, and you're there, you're an unsecured creditor, HMRC are now preferential again now, but you're at £30,000. What do you do? Directors not come to the table to talk to you. What do? You spend £3,000, £4,000 on a winding up petition as an unsecured creditor. There is that kind of fall down nowadays of where you take that process from. Okay, Mr. Director's just not coming to the table. He's not contacting us. What can a credit manager do? And I don't know the answer. I don't think any of us has got a proper answer. And that comes on to the next question is, Jason, I'm going to come directly to you. Do you think zombie companies distort the current insolvency figures?
I think without a doubt, they absolutely do. When we wind the clock back and look at what happened as and when the pandemic hit, you've got a real mix of businesses in terms of good businesses, bad businesses, and those that are somewhere in the middle. What the various support schemes have done, there's obviously a lot of positives to them. That they've allowed the wheels to keep turning, they've allowed people to continue to pay the staff, etc. But they have allowed companies that would otherwise have gone into some insolvency process and had their affairs wound up to just continue whilst those support schemes were available to them. And we have had a number of inquiries where we've been approached from sort of director side to say, oh, look, I've got this issue. What shall I do with my company? And their conclusion seems to be, well, if I'm not making the position any better, yes, I might not necessarily be paying anybody, but I'm not making it any worse because I'm not incurring additional credit. All I'm really doing is collecting my furlough money in and I'm paying my staff out. They're in a position where weren't actually forced to make any decisions, and we've got a real backlog of companies that probably should have gone bust a while ago that are just kind of sat there, still live on the face of it, and have not really moved anything further forward.
Okay, thanks. Charles, any thoughts on that?
I mean, again, sort of giving an international flavour on it, we see a lot of fraud going on in companies that have traded that aren't companies and zombie companies. That's certainly been on the increase for us and our investigations, and lots of copycat names, where people have set up businesses to look like another business. That's been going on as well. And again, answering the question about, where do you go, how far do you go? Obviously, overseas litigation is even more expensive, and in many of the countries that we collect from, they haven't got the backup. Forget taking any actions in India and Pakistan and places like that. The courts were backlogged backed up before COVID, so they're even worse now. So again, it's about saving face, and it's about being part of good forums to discuss these accounts if they're all dealing with similar suppliers. That's all you can bring pressure to bear, and directors being named and shamed to a certain extent. That's really the difficulty that we face, but we've got really good legal backup, and we'll look at the most cost-effective way of actually recovering the debt if possible. But as you say, depends on the value greatly. I mean, normally overseas litigation isn't worth even looking at. Anything less, anything over, $10,000 is sort of the limit that you'd even think about going legal.
Thanks, Charles. So, Pete, I'm going to come to you as you're the head of a debt recovery team for a prior law firm. The question is, what is your advice to a credit manager? Is there a simple solution to help ensure payments are on time? And are there any basic principles? Again, open-ended, but there you go.
I don't think there's a simple solution as such, but ultimately agree payment terms at the outset and set expectations to ensure that all parties are clear and in agreement. Communication is key, regular contact and keeping conversations going, and ultimately enforcing your credit control process if payment isn't maintained or made at all.
Brendan, I'll just dive in if I may as well, and what Peter said there too, is that what's interesting for me is the disparate. Now that there's so much information coming to light on the last couple of years accounting, people pulling credit reports to make decisions on opening new credit accounts, is that, not giving a big plug here, but it's a credit group. We work quite a lot with Co-Credo, and to be able to get 2 credit reports in front of you at the same time is quite fascinating and interesting, because the level of information is massively different in some of the reporting. So making those decisions initially is obviously where the credit manager comes in. We're all dealing with the back end of the business, so can comment on that and the type of cases that come in. But when you do get a case delivered and they say, here's all the backup, be it insolvency, be it debt collection, be it for litigation in the UK, having a look at the credit reports that they have pulled off initially is hugely different and quite interesting, to be fair.
Thanks, Charles. Okay, just looking at, we've just got a question.
I suppose just to add to that one, Brendan, I suppose it's always treading a little bit of a fine line, really, as and when you are asked to either extend your credit days or the amount that you're going to offer out there, and whether there's any scope for payment of old debt if they're asking you to advance your facilities that you're operating there, and just it's really difficult to say, but sometimes you just need to be a little bit cheeky and just sort of gauge things, and that's really best through the conversations and getting as close as you can with your oppos at the customer side.
Okay, thanks, Jason. I'll go into the next question, and I'm not sure where we go is, but do specific industry sectors have specific payment terms, and as a result can impact on insolvency numbers? I guess let's start with you, Charles. I mean, I know you've got the international hat on, but I know you've done a lot of UK stuff in the past as well. Are there different sectors with different payment terms?
Yeah, I mean, if you just straight off the top of my head, dealing with a lot of media firms, the media firms have got high profit. It's advertising, printing, online printing, so they can afford to give extended terms. There's no goods involved, so media, it seems to be one of the areas that we do a lot of work in. But of course, if you're on really small margins, like for example, people that are supplying fuel, that would be those. You can't change those terms because everybody relies the margins are so small. So that's where the difference is. I think is the easy answer, Brendan, is that if the margins are really slight and small, you can't change the terms. If you've got some,
it's so strange. We've just got in the question says it's from the senior credit controller from the fuel store, and it says I have no issues with chasing customers for payment and having a difficult conversation. My issue is finding a good collection agency, solicitor to act in accounts. We have left to chase at a 1.5% bounce rate weekly.
Yeah.
So
there you go, and that's what it's all about, isn't it? If you've got a huge margin, you can afford to take more risk. And I remember years ago there was a chap that used to talk about that, probably about 15 years ago, and he was a native Indian from the USA, and he was very blunt and very honest, and just said, if you can afford to take more risk, take more risk. If you can afford it with your margins, and I think it is as simple as that.
Can anyone do that now, though, Charles? Is there any sector that can do that?
Media stands out for me because that's where they sell a page of advertising for £10,000 or £20,000, or it used to be magazines, but obviously most of it's online and digital now. So maybe they've got the largest margins, but they sell on open credit all over the world, which is why we end up dealing with those kind of clients. So it's when you've got goods and not much margin, I think that's where people are really careful. Exactly like fuel, exactly like that. And that's from when I used to deal with one of the fuel suppliers at Gatwick, who was supplying all the fuel to the airlines, which was massively competitive, huge volumes, but tiny, tiny margins.
Good contract, though.
Thank you.
Okay, Peter, any thoughts on that one? I know, again, you'll work with various different sectors.
Yeah, I think ultimately there's a perception that the construction industry is where the worst payers can be found. But actually, over the past 2 years, it's the sector that's probably improved the most, because ultimately it was able to keep operating through the pandemic, while other firms struggled with employees moving to remote and home working, and payments slip through the gaps. I suppose sectors. Yeah.
Pete, you there?
Hello.
Yeah, still there.
Yeah, sorry, still here. So I just wanted to really add that to say that construction is probably viewed as one of the worst, but actually probably one of the most improving.
Brilliant. Okay, thank you. Okay, next question. What else can banks, creditors, and the government do to stop the late payment practices? Do bodies like the Prompt Payment Code really change the overall picture for late payments? Now, I'll start on this one because over the years, I never thought the Prompt Payment Code worked. And I've been quite vocal about that, and I've fallen out with a few people over the years about this because it was run by the CICM for many years, and that's been taken over now. I think is it Small Business Commissioner office runs it now. I've never thought it works because I think these kind of things need to be mandatory. Now, I'm not saying you can do that, but I think as long as it's an optional signatory policy, it's a difficult one. Charles, I know again you've always been like me a part of the Chartered Institute. Any thought?
Yeah, a big one. We at a stage we're getting around about 20% of the debtors from Europe when it first came in under the EC directive. We were using it as great leverage to get people paid, and it was talked about more then. And we had a lot of the time clients were saying, right, charge the late payment interest fees, charge the charge per invoice. But if the debtor wants to pay the principal sum straight away, then let them, as long as they do pay straight away. And we had a couple of weird contracts, I say weird, unusual contracts where we had one client who wanted to trial quite a lot of cases every month, again in the media business. to actually charge the late payment interest, and that was only where our commission was going to come from. So we were the ones that would only earn any money if we charged the late payment interest and fees. And the problem is, as we all know, and we'll probably talk about it, is that clients will try to impose it. Some of the debtors will pay, on average, 20%, and that's, again, Europe, etc. But then the minute that it gets the debtor starts to complain, then the client lets them off. So they want to keep the client relationship. And it's that big sales versus credit, sales versus collections debacle that always goes on, that in essence, we really should be able to prove that it works by taking legal action for the fees, which in some cases, as we all know, can be quite extensive. So that's my take on it. We always put it onto the fees, the principal sum, if the client allows us, and it's in their terms and conditions to do so, or the statutory interest. And I think as a stick, people do take a little bit of notice, but in reality, only 20%, if we're lucky, pay the extra fees.
And what about the code itself? Do you think, the guys who've signed up to the prompt payment code itself, I think help in any sense?
I think it was really well publicised to start with, but then it lost a bit of its fizz, and we don't hear about it a great deal anymore. That's just my take on it.
Is that because it's moved to the Small Business Commissioner's office?
Yeah, perhaps so. I mean, it should have. Should it have more gravitas if it goes to a part of government, or do people just ignore it because government can be a little bit soft about it, or are we, as credit granters and suppliers, being soft on the actual payment code in imposing it?
But then I guess the actual question, I guess we're kind of gone a little bit away from it, is what can the banks, the government bodies, what can they do to help with that, with getting customers paid quickly? Maybe not so the bank, but what can the government do any more than what they're already doing?
I think one of the big retailers pulled out of it fairly early on when they realised that they couldn't comply with the payment code. So do we not use that business for saying that they were going to do the prompt payment code and then not get involved? No, everyone needs the business. That's the problem, isn't it?
Mm-hmm.
Yeah, true. Peter, any thoughts on this one?
Yeah, I mean, just thinking whether the government could increase compensation and interest levels in the Late Payment Act as more of a deterrent. A radical approach might be to directly legislate to cap credit terms in certain relationships. For instance, maximum 30-day payment terms for subcontractors in the credit industry. Just as an idea.
Okay. Let's just move on to them there. Okay, moving forward, what advice can you give a credit manager and FDs in the new economic climate to protect their businesses? Charles, I'll come back to you. Any thoughts?
Again, it's credit reports. It's being involved with forums. It's talking, as I mentioned at the beginning of the call, a little bit old school. Find out, get friendly with other credit managers, get back to networking with them, and talk to each other about what limits you're setting. And I know from our point of view, we have a good relationship with the credit reference agency, and we have a trade agreement with them to exchange data on bad payers. And I think that works, especially again with a slightly overseas.
Charles, we lost you.
Oh, can you hear me now? Any good? Back?
No, not yet. Okay. No. I'll move on to Pete for the time being. Pete,
can I just add to that? Yeah, can I just add to that? Really just following up with what
Peter?
Charles said. Can you hear me?
Anyone there?
Brendan, I can still hear each other. I don't know. Can you hear me again yet?
Yeah, Brendan, we can hear Charles and Peter. I think it's just you.
Colin, are you there?
It's bizarre. Yeah. I think Brendan's lost us. Charles, did you?
Yeah.
Peter, did you want to add? Sorry.
Yeah, if I just add to what Charles was saying,
everybody, by the way.
That I completely agree. Getting a credit check.
I think we've lost complete sound on the.
Start, Peter. Carry on. Go on.
Credit checking companies before offering the credit, and we mentioned earlier about requiring directors to give personal guarantees. And
okay, I'm not sure if people can hear me, but I think we have to. You can hear me?
Yes.
Okay, I think I'm going to close the session there because I've lost.
That's all right, Brendan.
Brendan,
if you log in and log out.
I'm just ringing. I'm ringing Brendan. Sorry, guys. Brendan, we can all hear each other.
Okay.
All right. So we'll just carry on.
Brendan, you log in, log out. Sorry, Peter. Go on. Sorry.
No, not at all. Not at all. Just touching upon the personal guarantees, which might turn certain customers away, but I think in the long run might be a blessing in disguise. But yeah, just following up with what Charles said, certainly credit checking companies from the outset is certainly a good initial step to take.
Excellent. And Charles, you were going to add something. Sorry. Yeah.
The credit reports, the international forums, and like networking events like this, and the one we've got for the CICM tomorrow, where there's going to be 100 odd credit managers at the. I'm not plugging it, but it's a good example of where people really can get back to face-to-face networking. And it's the international forums that take place that we within the industry get involved with them, speak to credit managers who are in the same industry, and benchmark and talk to each other. Just like everybody always has done. We do like a bit of old school as well as using the technology.
Excellent. Good.
So Brendan's just logging back in, isn't he?
Yeah, he's going to log back in. But Jason, have you got any view on this as well?
I think some of the sort of naming and shaming that's kind of gone on across the construction sector has really helped to move things forward. The number of times that historically we'd been approached by businesses that have been having difficulty, they've grown over a period, and they've then seen an opportunity to land a really big contract with a main player in the construction sector, and then that big player has squeezed and allowed things to really bled the small contractor dry, such that taking on the biggest contract that the business owner thought was going to be their big win has actually caused the downfall of the company itself. So I think really some sort of, whether it's a blacklist or whether it's a bit of a naming and shaming, I don't think there'd be any harm in a little bit more of that going on, so that people can be wary that just because you're operating with a big business doesn't necessarily mean it's going to treat you fairly. They've got a lot of weight behind them and can really put the squeeze on the smaller firms.
Okay. We deal a lot with the subsidiary companies over in the Middle East of the larger businesses here in the UK, and it's exactly that it does get negotiations going to get payments made and debts paid. Is that when we can even speak to the UK shared services directors who, I know a lot of them of the big construction firms, that works well for us. So the naming and shaming, absolutely, it does work well.
Thanks, Charles. Can you all hear me now, guys?
All good?
Yeah, we can hear you, and everybody was all fine except for you, Brendan, ironically. So
I think it was
inappropriate.
I think it was a reaction. I think it was a technical reaction to the yellow polo. I think that's what happened.
I'll hand back to you. Sorry, Brendan.
No problem. Did we? I don't know. Did we just cover will changes in insolvency regulation having an impact on insolvency numbers?
No.
Okay. So let's move on. So Jason, this one's directly to you then. So will changes in insolvency regulation have an impact on insolvency numbers?
I think what we have seen in the last couple of years is a really slow market from our side in terms of insolvency numbers, because of the embargo on the petitions, the various degrees of support, etc., that have been around, and the lack of reason for directors to have to make decisions about what they want to do with the business. I think as the embargo has been lifted around the time that landlords have now been given back powers to pursue overdue rents, you've got COVID loans falling due for repayment. We've then got sort of supply chain issues across certain sectors. We've got fuel prices going up. I think what we're going to see generally now that now it's kind of game on is probably a return back to normal numbers, and that has been roughly what we've started to see over the first the last few months, really, when compared with normal times, i.e. pre-pandemic, things seem to now get now be returning back to normal. The thing is, the numbers that we're seeing, it kind of feels abnormal because we've had such a subdued period. But in any business cycle, there are a large number of businesses that do end up going through insolvency process, and we now just seem to be getting back to the norm. I think, to be fair to the government in the policies that they've implemented and what they've done, they have avoided what everybody was worried about in terms of there being a real tsunami of insolvencies, because they've managed to stretch the period out a little bit so that we've not had all the proverbial hitting the fan at the same time. But I said the unfortunate situation of businesses is that there's always going to be bad businesses that are failing, and they do need to have their affairs dealt with, because otherwise they become a bit of a problem and a blot on the landscape.
Jason, I mean, coming back to the insolvency numbers itself, I mean, from what I've seen on the creditor-led stuff, and these are the ones that Mr. Director is not willing to put the company in, so the creditor's pushing it over. From the compulsories that I've seen, compulsory liquidations, I think I did a stat quite recently, and it was 1 in 13 jobs that I looked at. This is companies that have actually gone into consolvency liquidation, had an asset, an asset that could be realised very quickly, not an investigation, but an asset could be very. So do you think those numbers are coming through? Is Mr. Director waiting too long to put the company into liquidation? Is it because he thought he could trade out of it, in the best intentions, not a dodgy director? What I mean?
Well, I do. I appreciate that. I think you do generally get a position where a director might put their head in the sand or leave their rose-tinted glasses on a little bit too long, because they can say, "Oh, yeah, we might be down in the dumps now, but our forecasts are always on the way up," and everyone doesn't like necessarily to admit when they've got a problem. I think a lot of the ways that we do get instructions director side are involving, there is a lot of stigma around sort of debt and positions and companies going bust, and people who will be sat sort of late at night doing the Google searching and identifying what do I do if I've got this sort of issue. And yes, there probably still is a degree of people waiting a little bit too long, but they've kind of been allowed to, which is the pro and con of the various bits of support that have been out there and available. The other thing that sits alongside this is there has been quite a lot of bad advice, and some of it sort of fraudulent advice in and around applying for sort of government-backed loans, whether it be a bounce-back loan or CBILS. I think there's been people who've been pushing that and kind of ignoring the last word of that, which is loan. People have been persuaded to go and apply for something, probably not even thinking that they were actually receiving some form of grant, not realising that actually they had to pay this thing back. So we do see quite a number of businesses where there's the odd few little bits of creditors. They've actually done quite a good job of keeping up to their payment terms, and then realised, oh yeah, I forgot I had this loan to pay back, and not being able to afford to do it.
Thanks, Jason. Okay, guys, this is the final question of the day, and I think probably needs to come to probably Charles, actually. So, analysts of data, can it really create an improvement in collection practices? Analysing data, I guess this comes back to all the kind of credit reference agencies and all the other kind of data collectors that we kind of will use on a daily basis in credit control debt collection.
I certainly think it can, and I know tomorrow again at the Law Society, Matt White will be talking about the use of data and AI in collections. And I know, having been involved at Morton Smith back in the day, we had the software business, and being able to see where clients had automated emails to do collections. What we put together there was an email campaign that went out to collect the debt. And within there were 4 different boxes that the client could dispute the debt, make payment immediately. So all of these bots that are around now, all of this AI that's allowed to look at collections becoming far more efficient, if you analyse that data, the credit manager can certainly do more. And I think one of the biggest projects that I've seen over the years was when, and what gave an amount of kudos to the credit manager, was that when he or she could take all of the data from the credit reference agencies, of which obviously there are many out there, lads. You can take all of the data from those credit reference agencies, and the credit manager could work out who sales should be selling to and get rid of all of the ones that they shouldn't be selling to. And they present that data based on their existing clients and the SIC codes from any other credit reference agency. I was going to say Dun & Bradstreet then. But when you can give sales the data from credit management and go, let's stop all this debt. These are the people you should be selling to. Don't go near those ones because it's going to be a long-winded and expensive affair trying to take that client on if you want, because they won't even pass credit. So this is who you should be selling to. And I've seen clients do that. We talked about it. And when credit managers have gone back to their businesses and done that after we've done CICM conferences, they have always scored big points, loads of brownie points. The use of data should be analysed even further and is invaluable, absolutely invaluable, especially these days when we've got big data to use now.
Thanks, Charles. Okay, guys, I'm going to pretty much wrap up. I've got one question I'm going to put to you guys, and that is, what are the speaker's views on issuing claims in the county court? Should delays in the court put creditors off using these proceedings? Anyone? Peter, maybe one for you, actually. I mean, you must get involved in some of this.
Yeah, absolutely. I don't think it should put creditors off from issuing claims in the county court, but I think when looking at pursuing a debt, you need to look at what option is best to use in order to make the recovery subject to the circumstances of the case. And in that respect, you have either the traditional county court route, where you are aiming to get a county court judgment to enforce, or you're looking at the insolvency route, so a winding up petition. And ultimately, you're looking to see if the debt is disputed at all, whether it's a liquidated debt, and whether it's over the financial threshold. So there are a couple of options, but I don't think the delays in the county court should necessarily deter a creditor from pursuing that course of action, particularly if it's a smaller claim, because in my experience, the smaller claims are still moving their way through the county court at a reasonable rate.
Thanks, Peter. Guys, I'm going to head back. I'm going to hand back to Colin now, because I think we just pretty much run out of time. So thanks, everyone.
Mute thing. I've done the mute thing. Sorry about that. Thanks, Brendan. Yeah, no, it's really great, really interesting stuff. Thanks for that. Sorry about the technical issues for people experiencing the event. We've had a couple today, unfortunately, but some really good messages in there, I think, from our panelists. We've got one more session now coming on 1 o'clock, looking at commercial credit management and technology. Ian Leslie who hosted our first session earlier in the day, will be joining us for that. But let me just wrap up by saying a big thanks to obviously Charles, Jason, and Peter for their thoughts. That was really good, and obviously Brendan for his fantastic chairing today. This has been recorded, so if anybody wants to watch this again, it'll be available on the Credit Connect YouTube channel soon. So I'd like to thank everybody for their thoughts and their questions, and hopefully we'll see you at a next session soon. Thanks, everybody. Cheers. Bye-bye.
Cheers all. Bye-bye.